Hi there, good evening and welcome to this special credit policy special, that is. Over the next half hour, we're going to walk you through the fine print of today's policy statement and also talk about how far it will go in improving the transmission of rate cuts through the system. Let's first start then by understanding decisions today taken by the central bank. As expected, the RBI has cut its benchmark interest rate by 25 basis points. The repo rate now stands at 6.5%, which, mind you, is a 5-year low. Now, while that didn't quite excite the market today, what was lauded were the series of measures that the central bank seems to have taken and unfolded to boost liquidity in the system. The RBI has also retained its target of 5% as far as consumer price inflation by March 2017 goes, and GDP growth forecast for the year has been retained at 7.6%. First, let's get you a word in from the Governor, Rajan, on the rationale behind some of the decisions taken today.
After reviewing the economic outlook and prospects, the Reserve Bank of India cut the policy rate by a further 25 basis points. This means we have cut interest rates by a total of 150 basis points since the beginning of the accommodative cycle. Our attention in recent months has turned to seeing that this large quantum of rate cuts is passed through into borrowing rates. The introduction of the marginal cost lending rate, the MCLR, since April 1st will help. Our first estimate from the 26 largest banks in the system, accounting for about 83% of activity, has been that since the last week of March, the median overnight MCLR is down by 50 basis points from the base rate and is down by 25 basis points across all tenures. This is important because it means an actual rate cut to the borrower of a further 25 to 50 basis points at least, even before today's rate cut. Put differently, policy action is significantly greater today than just another 25 basis point cut. Borrowing is now significantly cheaper and will continue to get so. To further this process, a major focus of this policy has been to address liquidity issues. After a detailed review and internal discussions, we've brought in significant refinements to our framework, including clearer differentiation between the durable liquidity needs of the system and short-term liquidity needs, indicated an intent to move closer to neutral on overall durable liquidity needs, reduced the MSF rate by 75 basis points, and increase the rate at which banks can deposit at the RBI by 25 basis points so as to narrow the interest rate corridor, reduce the minimum daily maintenance of CRR to 90%. All these measures, along with the government's actions on small savings rates, should also help continue the process of transmission. In addition to further durable liquidity provision, we have announced an open market operation, a purchase of government securities of 15,000 crores today. The monetary policy stance remains accommodative. Going forward, we will be looking for further monetary room in signs of good monsoon, further readings of low headline inflation, indications of softening in core inflation, and further evidence of transmission of rate cuts. Part B of this policy statement also has a number of reform measures, including continuing opening up of the banking sector, new market instruments such as money market futures, broadening participation in and easing access to markets, such as allowing retail customers the ability to trade GSECs and to undertake foreign exchange trades, and strengthening financial inclusion through measures such as improving the business correspondent network. Given the various measures that have been taken to fix the policy rate at close to the repo rate through these overnight instruments, the need to maintain the system in liquidity deficit no longer is there. Therefore, on a review of how far we had come with these overnight instruments, we decided that it was no longer necessary to maintain that significant liquidity deficit. We could move towards a more neutral position, which is what was announced today. The durable liquidity status of the economy will not affect how close the day-to-day call money rate is to the policy rate. That is determined by our short-term measures. That will continue to be determined by our short-term measures. and we hope to hug the policy rate as far as possible, with the call money rate to hug the policy rate. Whether we go into a little bit of surplus, little bit of deficit, I think that now is actually immaterial. The point is that we're moving towards that. The period over which we move depends to some extent on market conditions, depends on the flows that that come in. Remember, net foreign assets is part of the liquidity move. So we have to work it out. We have to see how this move takes place.
Okay, with that, let's take it across to our colleagues for more on how you should be reading this monetary policy. We've got our colleague Supriya Srinath, our consulting editor Maithili Bhusnurmath, and of course Nikunj Dalmia as well, with all corners covered. Supriya, you go first and walk us really through the key takeaways from today's policy, and more importantly, what should one make of, RBI Governor's commentary today?
So the biggest takeaway, if you ask me, from RBI policy this time around has been that there is a definitive change in stance of the RBI. In its own wisdom for all these years, the RBI believes that there should be a liquidity deficit in the system. That age-old wisdom is now being changed, and that is a change in the cornerstone of RBI policy, because they want to talk about a liquidity deficit going down to levels of near 0%, and that is very, very important. The second big takeaway is that the governor is trying to move beyond just interest rate reduction to do his bit for growth. So the liquidity boosting measures or reducing the liquidity deficit to near 0 are all geared towards that, and many people believe these measures alone will bring down the real interest rates in the real economy. Away from that, I think the governor is extremely convinced with what North Block is doing so far. He's talking about fiscal deficit consolidation being commendable. That's the word the policy uses. He also believes it has paved the way for disinflation. What the governor is losing a lot of sleep over is the 7th pay panel recommendations. He believes it could impact inflation by about 100 to 150 basis points. He's also beginning to lose some sleep over the recent upturn in oil prices and, of course, erratic monsoon. But away from that, the growth target is intact at 7.6% for this fiscal, inflation at 5%. Of course, downside risks do exist, and which is why he believes that supply side management and things like that happening in New Delhi will minimize those downside risks. But I think the big headline from this policy is that he's reduced interest rates on expected lines, which is just about 25 basis points, but he's done a lot of things outside of it to address the liquidity in the system and to boost liquidity. So that's really the big takeaway as far as RBI's policy is concerned.
Supriya, thanks for that. Maithili, would you tend to agree with that? The 25 basis point rate cut more or less being priced in, but what the market seems to have cheered to some extent are the measures towards boosting liquidity.
Well, the RBI has stuck to what the market expected. It's played by the book. What we have is a 25 basis cut in repo rates. The RBI has clearly eschewed the chance to kind of go for a higher rate cut because it is still worried about inflation. So as things stand, it's a 25 basis cut along with the promise of making the liquidity framework a little bit more accommodative, because in the past, even though the RBI had cut rates, liquidity remained tight. So now we have a promise from the Reserve Bank that it will have a more pragmatic liquidity policy, and hence the transmission, the pass-through will be better. And so we do hope to see lending rates definitely lower than they have been in the past, and that should perhaps provide a kickstart for growth.
Sure. Is the RBI confident, Maithili, did you get that sense that the war against inflation to some extent has been won?
As far as inflation is concerned, the RBI seems to have a fairly different view from what Dr. Pranab Sen, former member of the Planning Commission, seemed to say, that the 7th Pay Commission, RBI still has reservations about the impact of the 7th Pay Commission bonanza on inflation. It seems to suggest that it could mean 100 to 150 basis point in increase in inflation. So the RBI is wary about what the 7th Pay Commission can do as far as inflation is concerned. And to that extent, the RBI has opted to play safe. Clearly, the RBI still has its eye on inflation, and that perhaps is good for the ordinary consumer in this country.
Okay, before we talk about all the market action, let's get you the biggest voices from North Block and what they've made of the RBI's latest decision. As expected, it's a thumbs up coming in from New Delhi.
In coordination with the RBI, we really have to amplify both the fiscal initiatives as well as the monetary initiatives that are now in the pipeline, and that really is what we are working on now, is to amplify the policy actions that we have undertaken. As we do so, we believe that we will provide the boost to the economy that it needs. We obviously have to wait and see what happens with the monsoon and with aggregate global demand.
As you are aware, government has already kept the fiscal deficit under control, 3.9% in 15-16 and 3.5% is the target for 16-17. Inflation is low. RBI has projected an inflation of about 5% for next year. Government has also reset the small savings rates, and so under these circumstances the RBI's announcement of 25 basis points is therefore in line with the direction in which government would like the economy to move. And the banks have also, some of the banks have already reset their interest rates, taking into account the marginal cost of lending, the MCLR. They have taken that into account and done some amount of reduction of rates. Consequent to all these measures and consequent to the RBI's announcement today, the banks will perhaps need to do some more of transmission of the reduction in the policy rates by the RBI.
Okay, that's the view from North Block, but what is it that both market experts and economists have made of the RBI's latest policy? Well, here are the take on what things could really mean for the economy.
I'm still saying this is the first step, 50. If it gets narrowed further, then to that extent, in a frictional basis, if there is some short-term surplus, RBI is not too worried that the rate goes down maybe by 25 as it goes into the second phase or something. But if it was 100, that is something changes the overnight matrix for the thing. So narrowing the corridor helps in keeping the liquidity at the brink. And when you keep it at the brink, it might go surplus at time, it might go negative at time, but nominal negative, nominal surplus.
This would improve the efficiency of their liquidity adjustment, or rather the efficiency of the monetary policy objective itself, or rather the efficiency or the by which I mean that the ability to keep the call money rate, the weighted average call money rate, close to the repo rate even further. And in fact, it's a sign it's a sign that they are fairly confident that the liquidity adjustment facility is now working well to basically ensure that they can move away from a wider to a narrower corridor. But it's also a signal that they actually want to induce more liquidity.
The CRR minimum maintenance per day, bringing it down to 90%, eases the situation at the banks, because hitherto, since they had to maintain very high rates, then that was causing anxiety amongst the dealers, amongst the bankers, and they used to maintain excess liquidity almost on a daily basis. This leeway will certainly help. As regards the FCNR, he has made a statement that the forward cover has been done for the repayment of the FCNR deposit. The only concern is the forward cover has to be delivered by the banks, and who in turn would have to take it from the corporates. With the exports actually not picking up, that could be a small area of concern. Otherwise, I think they have done a wonderful job of maintaining the rupee, as also ensuring that the inflation has come under control.
The adequate liquidity is required in the system, although the policy has focused on the managing the liquidity issue, but absence of liquidity may hamper the transmission. So let's see, there will be some reduction, but numbers can't be given at the moment. But credit offtake, as I earlier said, it may be in the range of 10 to 12% in the current year.
The stand of dovishness that liquidity neutrality is something that they will pursue, and there are other measures coming, is a great ability in future to engender growth, and that's the most important thing industry will be looking at, and that both have been provided.
It looks like the governor's conservative cut in interest rates basically triggered a massive sell-off on the Dalal Street. Markets today have posted their biggest percentage drop in nearly 2 months. But keep in mind, well, disappointment from the RBI front, clubbed with some bad global cues to a large extent, has meant that the Sensex plunged something like 500 points. The Nifty also managing to just end a shade above 7,600. But the fact remains that banking stocks were bleeding in trade. Let's take it across to Nikunj, who's here to walk us through what's left the market so disappointed. Sure, Nikunj, a combination of factors, wouldn't you say? A disappointing RBI policy and not so good global cues.
An overbought market was looking for reasons to correct, and today there were a lot of factors which were at play. When we walked into trade this morning, There was some degree of profit booking in global markets. Emerging market currencies were under pressure, and foreign institutional investors who've been buying into emerging markets and especially Indian equities in last 3 weeks, they also are looking slightly reluctant. So there was an air of profit booking and there was some degree of nervousness which was at play. The credit policy turned out to be an event where traders bought in the run-up to the credit policy and they sold post the credit policy. There was nothing new or unique or disturbing from the credit policy, but the market levels were such that markets were certainly expecting something more than 25 bips. Nifty also has found some resistance closer to 7750, closer to 7700. So there are a lot of factors which are at play which add to today's market volatility. However, I would still like to give the benefit of doubt to the bulls. It's one bad day in an otherwise very strong market. What will keep this market going is that everyone is finding reasons why market should not go up. There is a lot of disbelief, and now more than Nifty I would focus on individual and mid-cap stocks, because as we roll over into the earnings season, traders would be talking about individual companies, individual numbers, and the focus clearly will shift from Nifty to benchmark, from Nifty to individual companies and names.
All right, Nikunj, Maithili and Supriya, all three of you, thanks so much for that perspective. Let's move on and welcome then two experts who are joining in on the show to basically help us read the fine print in this policy. We've got one money manager, that's of course Nilesh right here, and Mr. Rana Kapoor of Yes Bank is joining in as well. Both of you gentlemen, thanks so much for taking time out for us. Nilesh, let me begin by asking you, what's your take, from this policy, especially the way we saw the markets react to it? Would you say it was a bit of a knee-jerk reaction, or it's because the global cues haven't been very supportive today either?
If I have to measure the policy, it aims to lower the borrowing cost of the consumers by transmitting the liquidity. On the repo side, since Jan 15, now 150 basis point rate cut has happened, but the borrowing cost for the consumers hasn't come down because liquidity has remained tight. Liquidity has remained tight because of currency in circulation going up and government not spending money before March. Both this will get reversed in the month of April and May, and RBI has taken certain steps in terms of improving liquidity. All these things will result into lower borrowing cost for the consumers. This will be good both for the debt market as well as for the equity market over a period of time.
Mr. Kapoor, would you tend to agree? And how do you see liquidity shape up in the system post that reduction in the rate corridor now?
I think the overall liquidity situation, which was a little hampered over the last couple of months, should definitely improve. Partly because of RBI actions, and also because the government has to also release post fiscal year ending a lot of funds which are due to the respective industries. So right now there's also a situation where the government is cash surplus. So I think liquidity is a very major issue. It's not only interest rates anymore.
So, Mr. Kapoor, then what can be said about, the stance of banks like yourselves? Will you now be able to cut deposit rates further? And will that then mean, and perhaps even translate into a further cut in MCLR?
I think it's very early because, the whole banking system is getting adapted to the MCLR system. And I think this repo cut, because it has been anticipated for so long, is going to create only very minor corrections in the MCLR, because the MCLR in itself has been going through its own orientation and its own behavior in most banks. So we have to understand the implications and the longevity, because this is not a single rate, it's multiple of rates which has to make sense. So I think it's not going to have any immediate impact. I think after 30 odd days, when we realize that there is a accommodative policy, there is a dovish policy, then I have a feeling that ALCOs will meet and start transmitting low rates into the economy.
Nilesh, you were talking about how the governor has taken various steps to ensure that, there's enough liquidity in the system. Would you go as far as saying that today the steps indeed will sort of help improve the situation adequately?
Definitely, this month has been pretty unusual. The total borrowing by the banking system has remained above 2 lakh crore every day in the second half of March. This is primarily driven by unusual spurge in currency in circulation. It has grown by about 15% YOY. It is also by the fact that the government's cash balance with RBI has been upwards of about 130,000 crore. So this government cash balance and the currency in circulation increasing resulted into lower deposit growth, resulted into lower credit growth, and resulted into lower liquidity in the system. RBI has announced open market operation. It has announced reduction in daily CRR requirement. RBI is also making a statement that they want to bring liquidity to neutral level from plus or minus 1% of NDTL, which means they will do more daily repo. All these things put together will mean that April and May and June will be far more liquid than Jan, Feb and March.
Okay, so April, May, June, far more liquid, says Nilesh. But Mr. Kapoor, what about expectations from here on? We've heard the governor say that they're going to continue to remain accommodative as far as their policy stance is concerned for this year till the end of 2016. How many more rate cuts would you expect?
I think till end of 2017, I think is your question, right? And I have reason to believe that because the new fiscal year started now, till end of 2017, in my judgment, that with the right calibration, with the right sensitivity, with the right monsoon conditions, and with the fiscal kind of conditioning that the government, the finance minister brought into the economy, there's a very strong case to bring down interest rates by repo rates by about 150 basis points by March of 2017. That means we must get down to a target repo rate of 5% by 2017. Naturally, it's not only about India. India's logic may support that, but we also have to be delicate and sensitive to global factors, to global sensitivity of exchange rate movements, what's happening in China and what's happening in America, because those are the two most sensitive pockets in the world right now.
Sure. Nilesh, since Mr. Kapoor has talked about global factors, let's talk about what we are seeing the dollar do. There's been a little bit of, firming up of the currency after we actually saw it fall a little bit. As a consequence, you've seen the rupee just ahead of the policy, interestingly, actually hit a 2016 high. What's the outlook for the rupee vis-a-vis what we see the dollar do?
Rupee partly is driven by the dollar weakness. As dollar weaken, other emerging market currencies strengthen, and rupee has been, part of it. Rupee also benefited in the recent time as the flows from the FII on the equity side have been pretty strong. Month of March witnessed more than $3 billion of flows. However, rupee over a period of time will look at what is happening in September 2016 when India will be repaying $30 billion worth of FCNRB deposits. Today we have reserves to repay those deposits, but such a large outflow could create its own upheaval in the currency market. We expect RBI to manage that transition quite well, and rupee should depreciate over rest of the calendar year 2016 in a inflation differential between India and the rest of the world.
Right. Mr. Kapoor, while the RBI has said that inflation is likely to remain at about 5% and it's retained its target for March next year, they've also talked about how they're yet to really assess the kind of impact the pay commission could have on inflation. What's your own sense? What's the likely impact you think? And also, do you see the pay commission proceeds sort of translate into consumption growth for the economy?
You see, the pay commission and the OROP and all are very gestationary schemes. They are well intentioned. It's not like they're going to blow up money. I think the impact is going to be, first, more savings as and when the funds get released, and it's not going to create a consumption upheaval in the market. I don't think we need to be concerned. This has got a lag effect. It's got a gestationary impact. that we must be looking at these pension fund payments as a lubrication to the consumption economy of the country. We should not be seeing them as accelerators to the economy. So I don't think it's going to be creating any inflationary turbulence in the market, and we should not be concerned. I don't think this is going to create unusual demand in the economy.
Okay, fair enough. Our last question then, Mr. Kapoor, for you. Are you seeing signs of a revival in the credit demand, especially from corporates? And if yes, what's the kind of growth that you see for the fiscal?
The credit growth is, overall in the system very tepid. But it's a question of how do you find your niches? How do you define your, perspectives? And I think there is a opportunity right now in the system to respond to the green shoots in the economy, and that in itself can create some growth, impulses. So I think our bank, for example, is growing between 25 to 27%, and as a management team, as a board, we are very happy with that.
All right, Mr. Kapoor and Nilesh, both of you, thanks so much, gentlemen, walking us through what you've made of Governor's policy today. Before we go, we'll also talk about what Governor Rajan had to say as far as defaulters go. He's maintained caution with his views on the people named on that Panama Papers. He was a little more vocal on his criticism, though, for willful defaulters. But on the controversial question on whether or not the central bank will name and shame all defaulters, well, Raghuram Rajan left the decision to the courts. Listen in.
What we are saying is the act of default happens in business. Sometimes it's not your own fault. Demand is weak, prices are low, there's dumping going on by foreign countries, government permissions didn't come through, Supreme Court ruling took away some of these assets because they said null and void this allocation. Variety of reasons why a project gets into trouble. So we have no problem if the intent is to publish willful defaulter lists. That is where the promoter has, in the eyes of the bank, taken the bank for granted. The bank has gone through a legitimate process to declare the promoter a willful defaulter. That can be made public. In fact, some courts have prevented the banks from making those lists public. That's something that if there's a judgment along those lines, we have no problem.
That's it then on this edition of our special show, Credit Policy. Thanks so much for watching. Keep it with ET Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.